I think largely the sell-off that we saw, a lot of it was driven by technicals. I do think there was a big hedge fund unwind, and so you saw some technical pressure on the names. But getting it back to fundamentals, what investors that I talk to want to see is the first quarter and the full year outlook. So earnings is going to be very critical in an environment where there may be slowing growth, and our macro analysts at ISI think GDP will slow this year. A lot of that will be driven by contraction in European economies where Google and Facebook certainly do business. And so if we have a little bit of slowing growth, I mean, that could cap the multiple that investors are willing to pay. But this bounce back, whether it be 10, 12, 15, 20% for Netflix, I think to get another 10 or 12%, we're going to have to get through the outlooks. We're going to have to hear what managements have to say.
Do you think there's going to be any Apple-like surprises in any of these other calls? Is there the potential for that?
So you're asking about Apple. These companies, the U.S. internet names, the FAANG names, largely don't operate in China. And I think that was really what was pertinent for Apple. Now, they may blame macro factors in Europe. They may do what Tim Cook and Apple did. But, a lot of what hit Apple, whether it be China, a lot of what's kind of hit the equity markets, rising interest rates. I mean, these companies don't have a lot of debt. Rising rates could theoretically hurt the terminal value of these names. But basically, I think they're safe from those two factors.
I totally get that there was just a broad risk-off sentiment to these stock prices last quarter. But at the same time, their last set of earnings did see the revenue line miss expectations for a couple of them from Facebook and Google. So do you think those previous high valuations that they got when it was a real structural growth story that could go on for decades in people's minds, has that gone forever, or can those kind of come back?
Well, a couple of thoughts there. So first of all, I think that investors will gravitate to names that have more recurring revenue. So to your point, advertising is cyclical. So Facebook and Google, particularly in a slowing environment, would be potentially vulnerable to a slowdown. I look at Amazon and AWS and enterprise cloud services as being a really sticky subscription source of revenue. Similarly with Netflix, which is subscription revenue, more recurring. But yeah, I mean, the other thing that I would say is that the valuations of the two names that you mentioned in your question are not onerous at all. I mean, Facebook and Google are trading high teens on next year's earnings, mid-teens if you want to exclude the substantial amount of cash they have.
But Facebook and Google have privacy issues. And when you talk about Amazon, I see that angle of it. But FAANG has been responsible for the run-up that we've seen in the marketplace. And to Wilt's point, I don't know if that multiple on the bigger names are going to be able to carry us through the growth versus value that we just had the conversation in the prior.
So I think I'm going to say, I think we saw more multiple compression from regulatory concerns in 2018 than we will see in 2019. I actually think that, first of all, with the government shut down and a divided government, it's going to be hard for any privacy legislation to get passed. Right. But I think even if it were to be passed, it actually could be a good thing for these companies if it looks like GDPR in Europe or a watered-down version of that.
Let me ask you very quickly about Amazon. We've been talking off camera about the Amazon divorce, but there is a real question for shareholders if this thing gets messier than had been expected. If that stake, his 16.3% stake, gets sliced in half, what is the risk?
No, okay, so Mackenzie Bezos would be entitled to half of that property. That's joint property. They were married before Amazon.com was founded. So presumably, if those shares are divided, she would be an 8% shareholder of Amazon. So it's a real question for investors. What does she do with those shares? Does she sell them down gradually over time, the way Steve Jobs' widow, after he passed, did with her Disney shares? I don't know. I mean, I'm not a divorce lawyer. She may say, I want cash. Certainly, Jeff Bezos can't fund the value of half of his stake in Amazon. But it's a real, I think, question for shareholders if those shares are going to be sold in the marketplace.
For her, I don't see why it would really matter. Have stock, I'd take stock or cash.
Yeah.
I understand,
but
I'd be
diluted and it's 8%.
You can have as much cash as you'd ever want based on and still hold the shares. You
but if there's a vindictiveness, if she's upset, then things could get messier.
That's amazing that you're talking about, $65 billion worth of Amazon securities. That if someone is mad about text, that they can actually
You
affect
watched it
your.
with-
I know.
Well, it's
I know.
interesting that
I know.
there's only one share class, right? So they're
Yeah.
not super voting.
Right.
So in that scenario, you could even argue that the vote on a per share basis has more value because the minority shareholders,
Well, there's another thing. Just
Have
hold the vote, I'm
more-
going to vote against you.
Right.
so. I mean, maybe over time she can negotiate, if it's cash instead of the shares, she can negotiate.
Was it confirmed there's
higher
no
cash.
prenup? I mean, that was a TMZ. I tend to think, I don't know why there would be.
He wasn't a millionaire until 4 years after they were married.
They both started it
Yeah.
to sort of to get. Yeah.